You're listening to ChooseFI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. ChooseFI, your home for financial independence online.
All right, guys, super excited to talk about this past week's episode with Paula Pant. This is someone that has done so much for this community, so much for this movement of financial independence, and someone that Brad and I both deeply respect. And to get a chance to not just explore her thoughts on financial independence, but to really go back and explore her origin story was something that both of us went into being very, very excited about it. And I was not disappointed by that episode. What a compelling story. And so to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I am doing quite well. Yeah, that was a phenomenal episode with Paula. Just a really great conversation. Wonderful to have her on. And it was really interesting to dive into her story and, like you said, her origin. So we'll certainly talk in great detail about that. But yeah, it's getting close to mid-December. I hear you have some travel plans going on, right?
We'll talk about controlling our schedule, which is a thread that we were talking about with Paula. I am leveraging my ability to control my schedule and taking off basically the entire back half of December to go visit my wife's family in Zimbabwe. And she actually hasn't been home. I mean, this is really, it ties well, so I wanted to start here. She hasn't been able to go home at Christmas to her family since like 2007. And in large part, that was because with my schedule as a pharmacist, while I could take up to 2 weeks off of my 20 days, I could take 2 weeks off. I could never do that at high volume peak times where people with more seniority were able to do that. So, basically when people go through the list of what they want as a relatively newish pharmacist, you had what was left. And it certainly wasn't Christmas.
So because it was flu shot season at the pharmacy, you couldn't actually go back and visit your wife's family?
Yeah, I mean, even more than that, it was just not everybody can take off at the same time. The people that have been there longer, to some degree, rightfully so, right? I get it. People that have been there longer get their pick, but not everybody can take off. So the pharmacy stays open. So, I was not able to do that. And we just kind of accept it. And I said, Danny, don't worry. Maybe in like 20 years, then I'll have enough seniority that we can go home at Christmas time. I know a manager at one of the locations that literally hadn't been able to take Christmas off for over 20 years. Like it was just a known thing that at this particular job, you were not allowed to take Christmas off. And to me, I always that was never okay. It just simply wasn't okay. And insert your holiday or time period of choice here. Just the fact that something was forbidden to you because you had to, pay the bills. I'm not cool with that. And I love that Paula brought it up because I was like, yes, that speaks to me.
Yeah, I hear you. She said, I'm going to be facing 40 years of having a 2-week vacation, maybe 3 or 4 weeks if I'm lucky. That was a point to me as well. When I started my first job when I was 22 years old, I was looking at, like a 40-year career where I'd be really fortunate if I could take off more than 10 calendar days in a row. And we just kind of take that as a given, which is really sad societally, but it's just not good enough. And yeah, I'm happy for you, obviously, that you have this flexibility now.
Well, what I'm going to try and do is build a little actionable takeaway into this particular point, because the fact that I am able to go do this travel has provided me with the opportunity to try to do it smartly. So to tie this to what we talked about with Marla last week on our travel rewards update, episode 104R, as we were kind of rolling out travel strategies for 2019, I'm making this trip and I was going to use travel rewards points to go to Zimbabwe. That was the goal, but I noticed that the redemptions for travel weren't as good as I was actually hoping. And so that kind of goes with one of our other themes that when you're using travel rewards, one of the amazing benefits of doing this from a place of financial independence is that you can travel when other people aren't traveling. So not only do you get better rates when you're paying out of pocket, but you also get better redemptions when you're using your travel rewards points. So when I was looking at traveling over Christmas, obviously the redemptions were not as optimal. So that was not a place that I was going to get major savings. But what I was able to find, there's actually a snowstorm coming and hitting Richmond, and we decided we wanted to get up to DC, which we'll be flying out of ahead of time. And normally we pay for parking at the DC airport just because we're rushed. We're getting there early. We're at the airport and we just don't want the stress of having to figure out the parking situation. We normally pay $10 or more a day. And if you're gone for several weeks, that obviously adds up. Because we decided to get there a day ahead of time, I looked up parking and was able to find parking at a hotel I think I used an app called Spot Hero, but I was able to find parking at a hotel for $6 a day. And the hotel offers a shuttle to the airport. What I found is the hotel is actually Hyatt. So I was able to use my rewards points, my ultimate rewards through Chase. I was able to transfer them to Hyatt 1-to-1, got the hotel for 5,000 points, but that hotel was the same hotel that had the parking. And then I was able to basically, as well as that, get my parking for only $6 a day instead of $10+ a day, saving me some extra money there. So it was kind of, leveraging a couple different tactics to kind of find a win inside the margins.
Wow, that's very cool. It's funny. I actually did something similar when we went to Europe this summer. We drove up to Dulles Airport the night before, probably stayed in either that same Hyatt or there a handful right around Dulles Airport. So yeah, I think it was 5,000 points per night. I just transferred them from my Chase Ultimate Rewards account to my Hyatt Rewards account and just booked the hotel. And then, yeah, it was something very, very similar. It was like $6 or $7 a day for parking, which was fantastic as compared to parking at the airport. So yeah, that was a pretty solid strategy. And also just from a stress perspective, we decided to head up the night before, very similar to what you're doing. We didn't want to risk having to get up at 4 a.m. to get an early flight, but B, just having that stress. So it just made our lives a lot easier to go up the night before, stay in the hotel, hop in the shuttle in the morning and just get there and just leisurely make our way to the flight. So yeah, that was a big win for us as well.
Cool. Now, little strategy there just for people that are looking at hotels and I think it's just worth revisiting, and we'll probably come back to this again in the future. So I was because I haven't done a ton of Hyatt redemptions, I wasn't 100% sure whether or not I was getting a better deal going through the portal, the Chase Ultimate Rewards portal. And since I have the Chase Sapphire Reserve, I get a 1.5 cents per point redemption through the Ultimate Rewards portal, or whether or not I should just go directly through Hyatt, because you have a couple different options in this regard. And if you think about it, our kind of target standard is we shoot to try to get around 2 cents per point. And if you've listened to episode 9 of our podcast, that will make a lot more sense. But we shoot as a target to get a 2 cents per point redemption. It won't always be that. Sometimes it may be much better. Sometimes it might be worse, but it will never be worse than 1.5 cents per point because I have that backboard of the Chase Sapphire Reserve. Well, first what I did is I went and I looked to see what the cash price per night would be, which is right around $110. Since the cash price for it was like $110, I went to the Chase Ultimate Rewards portal and I saw that it would cost somewhere just over 7,000 points per night if I went through the portal. But I knew since it's a Category 1 hotel, it would only cost me 5,000 Hyatt points. So the clear and obvious choice to get a better redemption was just to transfer my Ultimate Rewards points to Hyatt. And so you have to go create a Hyatt account, and then you transfer your points over to whatever that member number was. They show up instantly, and then you were able to redeem it for just 5,000 points. So I know that was a little wordy, Brad. I'm sure you can help me clean that up. But Hyatt was the clear winner, and it was really nice to have that travel partner be paired with my Chase Ultimate Rewards points.
Yeah, no, not wordy at all. That was exactly a succinct version of how I'd approach it is, yeah, you look at the cash price, you look at how many points it's going to cost as a traditional award booking, and you figure out which is less and determine, first, I guess, does it make sense for me to use points at all? And in your case, it did. So that seems like a slam dunk. So how long are you guys going to Zimbabwe for?
Let's see. So we will be there basically from the 10th to the end of the month. So by the time that this episode is released, we will be over there, and I will hopefully be past my jet lag.
Very, very nice. Well, cool, man. I'm glad that worked out. That should be a lot of fun.
What's really interesting, and we're going to have to test this, is although we have not yet tested whether or not the internet will actually be good enough for me to produce this podcast from over there, which is why we've prepared several of these ahead of time. But in theory, if I get over there and me and you do a test run, there could be a situation where we could actually record several weeks worth of content actually overseas. So that whole location independence thing will truly be a reality for us. But I haven't proved that out yet. And it felt kind of too high a risk to go all in on that hand. But all right, that's my rant on controlling your schedule. Let's talk about some other themes from this episode. And I think one of the places that I wanted to start with was this whole idea of taking action and just doing something. You had a great conversation with her talking about imposter syndrome. And it really sent her in a wonderful direction where she was able to talk about it as a journalist.
Yeah, I definitely did not anticipate Paula's answer on that at all. And I was just so impressed by it. It's just reframing it mentally, right? For me, I would have had that imposter syndrome. Who am I in my early to mid 20s to be the financial expert for a fairly large website, even with no financial background? So to me, that would have been my first thought, is that imposter syndrome. But Paula looked at it so intelligently, saying it was as if she was a reporter and her beat, if you will, was the personal finance beat. And how do you learn? You learn by asking questions. And I think that is such a crucial aspect of succeeding in life. How do you learn? You learn by asking questions. You find people that can help you, that have the knowledge, that are willing to spend their time and give you that information. And also, you've got to do it on your own. We have Google, and you have every piece of information in the world a fingertip away and a search away. So if you want to learn something in this day and age, in 2018, you just search for it. And that's the beautiful thing. You can learn anything. Anybody can become an expert if they're willing to put in the time and the care and the energy.
And Brad, you're making such a brilliant point. And I want to highlight the privilege that we have literally thinking about this problem in this era, in this exact year. And I mean, just put yourself in the situation of a philosopher like Aristotle. If they wanted to answer a question or do research on something, put yourself in the situation of a creative, like a painter, like Michelangelo, when they're perfecting their talent, their techniques, or an inventor like Thomas Edison, what hurdles they had to go through to actually create something, and realize that right now, the baseline of what you need, the information that you would need to build on is there and it's free. And you literally just need to start by asking a question. Everything comes back to your willingness to ask a question to help inform your answer and then build on top of that. It's a wonderful time to be alive. And I think that kind of spilled into some of the excitement that we had going into the end of that episode.
Yeah, no, I hear you, Jonathan. I know you were a little taken aback. I think Paul and I went out in left field there for a little bit with terraforming Mars and such. But
you remember.
Oh, I remember. But I mean, and will that ever happen in our lifetimes? I have no idea. But it's just fascinating that people are thinking about this stuff. People like Elon Musk, Bezos, people are actually thinking about this. And believe me, they're far surpassing me in every possible way. And these are their dreams. So who am I to say it couldn't happen, right?
Absolutely. And you know, the other thing she said, and it actually ties back to the episode that we did with Doc G, you don't need permission. If you want to be a heart surgeon, you need to go to school. I don't want you working on me if you haven't gone to school. We're not going to interact. But for everything else, right? For everything else, you are because you do. She's like, why do people think that I'm a real estate expert? It blows my mind, because if I have imposter syndrome with anything, it would be with real estate. You know why I'm a real estate expert though? Because I've done it. I stretched myself. I put myself out there and I did it. And Brad, her process for getting started was not super inspiring. This was not a guru. This was someone that was just willing to do the math. And I would say now she has probably obtained that guru status just due to practice, trial and error, perfecting her techniques. But on day one, it was, how can I save $200 a month in rent?
Yeah, I imagine Paula of today, the expert, right, would be aghast that she bought her first triplex to save $200 a month and just did back of the envelope math and really essentially nothing else. That's pretty amazing. This wasn't paralysis by analysis, right? She looked at her pain point in life. While it sounds crazy to say her pain point was her most expensive item of $200 per month, that was the fact for Paula then. She wanted to figure out a way to cut that expense to zero or maybe even positive. So she looked at what her landlord was making, made some calculations, and then saw this place open up literally across the street, bought it, and then it sounds like moved all of her roommates over there. I mean, it's amazing that she took action like that. And I mean, that to me is the takeaway, is take action. Just jump into something, do it, research it, find out if you can do this, and do it.
And Brad, what was so striking about the conversation is, although obviously on this show, we always talk about things through a financial independence lens, for her, she was more just thinking about, how can I create passive income? That was it. How can I sustain my lifestyle anywhere in the world?
Yeah, she had these inflection points where she was almost looking at the world slightly differently and away from just the conventional thinking, right? Like conventional thinking for her at that time or people in her industry of the reporting game and newspapers and print, certainly, at that point was keep your job. Don't ever leave it. It was the Great Recession and she had a job. She looked at it and said, wow, you mean there's this freelancing out here that I don't have to be stuck to this job, this 9 to 5 or more than that forever, that I can create my own business in essence, right? So she had that first epiphany and that first inflection point when it came to freelancing. And then she had a second one when years later it came to finding passive income. And she said, in essence, she was just, quote, setting up streams of passive income. She was looking for just different ways that she could earn money. And I thought that was really cool that she had these 2 points that she could look back on in her life and say, those were turning points, even just having that different thought. And now, Jonathan, it sounds like to us, passive income and freelancing, we get that now, right? This is part of the vernacular of the financial independence community. But that wasn't the case when Paula was going through this. So these truly were these life-changing moments for her.
Yeah. And to be honest with you, her just zeal and enthusiasm, it's contagious, man. Just being around her and being around her spirit is just being around her, and her enthusiasm is completely contagious. And frankly, Brad, it makes me very excited for this next announcement.
Jonathan, if you remember, probably about 6 months ago at this point, we had talked about creating a scholarship for members of our community for Treehouse, the coding academy. And we had actually preliminarily partnered with a not-for-profit, and they were going to help us. But then you and I kind of decided, hey, maybe this is something that we can get off the ground ourselves. At that point, we had these limiting beliefs that how could we, or who are we, to form a not-for-profit? But in tandem with Edmund, who has come on board as an integral member of our team, we decided to move forward with this. And yeah, I'm really excited to announce that as of a week ago, we formed the ChooseFI International Foundation. This is like so incredibly exciting to me. We have an entity that we're currently applying for not-for-profit status. And as soon as this gets approved by the government, then we're going to really move forward in earnest with this. And it's going to be a bunch of major aspects, right? It's going to be financial education and certainly financial independence education. And it's going to be scholarships, both for members of our community. The military is a huge aspect of our community, so we're going to focus on that. And yeah, I mean, Jonathan, I'm just so incredibly excited about this.
Now, many of you are wondering, well, what does that have to do with this roundup? And I'm excited to announce that we asked Paula to join us as a director on this newly formed nonprofit. And she said yes. And I just could not be more excited to have her on board. This is someone that has a calling, a passion for this community, and already has done so much. If you visited affordanything.com or listened to her podcast for any period of time, you know that she is passionate about having an impact on the world. She's already done a lot of work on behalf of Charity Water, an organization that tries to get clean drinking water to some of the most impoverished communities in the world. When you combine that with her love of financial education, it's just an obvious pairing, and we are just thrilled to have her on board. So we will circle back to this in the spring, and we'll all come on and kind of talk about what this is and where we think this could go. But very, very exciting, and we can't wait to see what comes out of it. All right, guys, we have a very special guest for the second half of this episode. We're bringing Brian Feroldi back on the show. If you remember from episode 75, the unique advantages of the individual investor, just a fabulous episode looking at maybe some of the advantages you have over individuals at Wall Street. Now, I think you know, if you've listened to the show, that Brad and I are still and will always be huge fans of low-cost index fund investing. And we have spent a lot of time talking about how inefficient and suboptimal assets under management investing can be for your average investor. What we realize, though, is that there's a lot of options in between those two. It's not A or B. There's options C, D, and E. And Brian was highlighting one of these alternatives and making a strong case for it. If you haven't listened to that episode yet, I think it's a valuable use of your time. What we wanted to do today, though, is just because, frankly, we're huge fans of Brian, we wanted to have him to come back on the show, highlight maybe some feedback from that episode, and talk through a couple additional questions that we had. And then also, at a very fun level, he just recently released an article on ChooseFI.com As you guys know, we really like looking at the math of all sorts of different things, and solar panels are one of those things that sound great, but if the math doesn't make sense, then, you just you got to be honest with yourself and what that means for your finances. We asked Brian to come back on the show, and one of the things that I wanted to talk about is he tackled this really cool project of doing a cost analysis on whether or not solar panels are worth the investment. And this is just such an interesting conversation because I think all of us are kind of interested in optimizing our electric bill, or at least you're very interested in it in December. And I went to, and this is a funny story, Brad, I actually went to a farmer's market, and there was a representative there from Dominion Power talking about renewable energy sources and kind of giving us a way that we could help contribute towards some of these. And she was kind of walking me through some of the things they have and basically saying that we could donate some of our power back to the grid, et cetera, et cetera. And then I just noticed the subtext there being that we would be able to help by paying an extra 13% on our energy bill. And I said, have you seen my monthly energy bill right now? It's insane. So, if I love the idea of having a more efficient energy bill and using more efficient resources. I'm not exactly a huge fan of the idea of paying 13% more. This conversation with Brian can kind of bridge the gap because you get the best of both worlds. You are using a renewable energy source and simultaneously, but you have the potential to slash your expenses. And I just think this will be a fascinating conversation. So with that, Brian, welcome back to the show, buddy.
Hey guys, it's awesome to be back. Thanks for having me.
Brian, we had you on back in episode 75 talking about the unique advantages of the individual investor. But what strikes me is kind of just like us, you're a guy that just likes to look at the problem a little bit differently and see if there's different ways to optimize, not just accept status quo, but just let's run the math and see what the math actually says about this. So what got you interested in solar?
I've always liked the idea of lowering my fixed costs as much as possible. When you have really low fixed costs, as you guys know, it just opens up a world of opportunities to you. A lot of fixed costs you can't do anything about. Like I'm a homeowner and I have a fixed cost of my taxes on my real estate that I have to pay every single year. If there was a way for me to reduce those, I would absolutely explore it. But one of the ones that I've always known that you could reduce is your own electricity costs. So I started to research solar just to get an idea because I have friends and family that went solar. They put solar panels on their house and the utility cuts them a check every month instead of you paying your electric bill.
Wait. So are you describing a negative energy bill?
I am describing a negative energy bill where your utility literally pays you every month for having solar panels on your house. So that piqued my interest. I did some research into the incentives that are out there on both the federal and the state level. And it turns out that it depends on where you are in the country, of course. But for some people, putting solar panels on your roof can both lead to a negative monthly electric bill on average and can provide you with a almost guaranteed double-digit return on your money. So that's a very attractive proposition that I wanted to look into.
So, Brian, you said depending on where you live, is that based on state incentives? Is that based on, let's say, the type of sun that's available in your state? Is it based on the electricity bill that you would pay normally, depending on where you live? How would one even get started figuring out if this might make sense for them?
Yeah, so there's a dozen or so factors that will affect the math in your particular situation. Your roof, how old it is, the pitch of it, which direction it faces, what the sun's like in your area, the state incentives. There are just a number of different variables. So if anybody is interested in solar, the first step is just to contact a couple of local installers, and they will come to your house for free. They will go up on your roof. They will take measurements with like a sundial thing, and they will present you with multiple avenues for buying a system, finance a system, possibly leasing a system, as well as different spots in your house can do it. And they will just do all the work for you and lay everything out. So if you're interested, make sure you contact them, and they will basically go through all those items that you just discussed, Brad, to present the options to you.
So it strikes me that obviously the first cost is just how much does it cost for solar panels? And one thing that you mentioned in there was that you also need to look into how new or old is your roof. Because if you pay $20,000 to get solar panels installed and it's on an old roof with only a few years left, and then you have to reinstall the roof, that means that practically you're going to have to take all the solar panels off and pay additional for that. So that just needs to be weighed into the calculation. Am I understanding you correctly?
Yeah, correct. Generally, if you think that you're going to be replacing your roof within 5 years, solar panels typically won't make sense until after you replaced your roof. In our situation, we did put a brand new roof on our house and then after that put solar panels on. You can contact your solar company to come and take the panels off and then put them back on after. But like you said, that's both hassle and there'd be a cost for doing so. So that is something to keep in mind.
All right, Brian. So let's start from the beginning. Your curiosity was piqued here by this negative energy bill, and you got started looking into it. How did you actually do that? And talk us through the process and kind of where you are now.
Sure. So I live in Rhode Island. I am a shareholder of Tesla, and Tesla owns the biggest solar installer in the country called SolarCity. So what I did was I contacted friends and family that had solar on their house. I asked them who they used, and then I also reached out to SolarCity, and I had a local installer named Newport Solar as well as SolarCity come to my house, went up on my roof, did their measurement things, and kind of presented me with their information. And the nice thing about doing that is those companies have relationships in place with the local towns, the local governments, and they know the most up-to-date incentive programs that exist, so they will do all that research for you. To my surprise, I'm a Tesla shareholder. I'm a huge fan of Elon Musk. I thought that SolarCity was going to be the slam dunk option just because they're the biggest. I figured they would have the best deal. It turns out that in most cases, more often than not, your local companies actually provide you with lower costs and are more willing to give you breaks here and there than the bigger companies, which is kind of exactly the opposite that I thought. So when I was presented with both packages, I ended up choosing my local company named Newport Solar over SolarCity, even though I wanted SolarCity to win my business initially. But they came and they presented me with two basic options for putting the panels on my house. The first option, the panels themselves would cost about $26,000 upfront. If I went with option A, I would have qualified for a $7,300 energy fund grant right off the top that was through my state. That would have brought the price down to about $18,700. And then from that number, there is also a 30% federal tax credit that you can reduce off of your taxes. It's a dollar for dollar credit off of your taxes. So that would have brought the net cost of my solar project up front to about $13,000. If I went through that avenue, my solar bill would have dropped from about $1,450 per year to about $330 per year. So there would still be a cost to me to get electricity, but it would have been, $1,000 per year in savings. And if you just do the quick math on that, it's about $1,100 per year in savings, and it would have cost me about $13,000 up front. That's a cash-on-cash return on your investment of just over 8%, which is quite good, especially when you consider where, keeping your money at the bank would pay.
Wait, I just want to pause here and let Brad geek out over this for a second. 8.5% rate of return for installing solar panels. That's insane.
Yeah, that's amazing. And you're locking it in, right? You're locking in this savings. How many years would you anticipate that being valid for?
It depends on sometimes you have to sign a contract with your local utility. I believe that would have been for about 15 years. But if you do use the rule of 72 on that, 8% return, that means you get basically all of your money back within 9 years, which is quite good.
All right, Brian. So just to slow it down, the credits you talked about, slowly go through that, and what would be available to anyone federally, and are there ones that they have to look into on their state or even locality?
Yes. So the federal tax credit applies to anybody in the U.S., and it's basically a 30% credit that goes on your tax bill your next year directly for what you paid upfront for your solar panels. So as I said, my panels would have cost me about $26,000 upfront. That was the estimated purchase price with the installation and everything like that. If I didn't qualify for any state program at all, it would have been that $26,000 times 30%. So that's just over $8,000 that I would get to subtract from my next year's tax bill. So you still have to pay that $26,000 up front, but you'd get a substantial tax credit later on down the road. And that tax credit is available to anybody in the U.S., though I will point out that it is about to start phasing out in the next couple of years. So this is something that if you're interested in it, definitely look into it sooner rather than later.
Now that's awesome. I love that we ran through that and we mentioned an 8.5% basically rate of return, which is pretty cool. That's kind of a very attractive option. But I know that is not actually what you ended up going with. You kind of did a slight variation on that, and I'd love for you to tell us about it.
Yeah, that first option I talked about was for a net metering program, which is when basically your dial spins forward when you're using energy and backwards when you're not using energy. So during the day when the sun's shining and you're not using much, it's your panels are actually causing your meter to spin backwards, and that's reducing your electric bill. But you are still having a monthly fee because you're still a net user of electricity from the grid. Now, in my particular instance, my utility is National Grid in Rhode Island, and they were providing something called a Renewable Energy Growth Tariff Program for residents of my state. Now, the way that worked is that the electricity that I generated with my panels would not be only used by my house. Instead, that the energy that I produced would be actually pushed out continuously to my local microgrid. So that would be used by me and my neighbors. Now, the kicker was that if I went with that program, I would not qualify for the state incentive up front. However, I would be able to sell the electricity that I produced at my house back to the grid at almost double the price that I had to buy it from the grid. So to put some numbers on that, electricity by me costs about 18 cents per kilowatt hour. But using this program, I would sign a contract with National Grid to sell it back to the grid at a rate of about 35 cents per kilowatt hour. So the way the math worked out on that is the cost to me upfront would be $26,100. I would qualify for that 30% federal tax credit. So the net cost to me upfront out of pocket would be about a little over $18,000. However, with the electricity that I would produce, because I would be selling it back to the grid at double the price that I was buying it for, the value of the electricity that I produced in a given year was about $2,200. So that $2,200 divided by the $18,000 upfront cost was good for a cash-on-cash return of about 12%. So that would actually result in me getting paid by National Grid every month.
That is so cool. So how do you calculate how much energy your solar panels are going to produce?
Again, that is calculated by your local solar companies. They will come and, depending on the pitch of your roof and how much sunshine you get, they will do all that math for you. In my particular case, they estimated that my solar panels would produce 6,500 kilowatts of energy per year. And that ended up being within about 5% of what my actual production was. So their estimate was actually very close to what it was.
That's amazing. So you're locking in a 12% rate of return and you're actually selling this. That's remarkable. Are there ways that you could pay for people's solar panels like on other people's roofs? Or, I mean, if you could lock in a 12% return, right? I'm sure your mind, Brian, of all people, was just like spinning.
Yeah, definitely. I mean,
Brian's entire neighborhood has solar panels.
Paid for by Brian.
All financed by me, yeah. When they showed this to me, I asked them to basically max out my roof with as many solar panels as I could possibly fit up there to make this deal work. You do have the option of doing more or less depending on how much money you want to spend up front. But when I learned that the return was that good, I did ask them to basically max it out so I could take maximum advantage of this. And the thing that I really love about this is that it turns it is hard to write a huge check up front to get them installed on your house. But now, from like now on, my electric bill is something I look forward to getting every month. I look forward to seeing how much money National Grid is going to deposit into my account every month. And it just permanently takes this fixed cost for this necessity that you have, and it turns it into income for you. It's just fantastic.
Brad, I told you were going to be excited about this segment.
Yeah, I'm beyond excited. So sure, it's hard to cut a check to pay for this, but in essence, you just bought an asset that's an income producing asset. This is akin to buying a single family rental, right? Or rent some type of rental real estate.
Yeah, it definitely is. And as you guys know, I am a stock market junkie. I love to invest in the markets, and I've done very well. But what's so attractive about this option is that it's basically guaranteed. I mean, you're betting on the sun shining as it always has over the course of a year.
And if it doesn't shine, you've got bigger problems.
Exactly. And I want to just point out something. The math that I presented to you guys was the actual cash on cash math. There is a legitimate argument to be made that by putting solar panels on my house that cost me $26,000, that the price, the value of my house simultaneously went up $26,000 when I put them on. If you factor that into the equation, the return gets even better. And that's kind of theoretical, but ask yourself this. If you guys were shopping for a house, would you be willing to pay more if the house came with a negative electric bill?
You make a compelling point.
So if you factor that in, that $26,000, that asset that I have on my house, that I net paid $18,000 for, I mean, the return goes into the stratosphere if, in fact, you do factor that in.
All right, let's just slow down on this just because I think all of us are like, man, I need to go buy solar panels today. Someone's listening to this and they're thinking, okay, how much of this works anywhere and how much of this was just for Brian in Rhode Island? And then also for someone that wants to start researching this, like what is the stepwise process? What does someone in Richmond, Virginia do if they want to start running a similar analysis?
So the math that I presented to you guys just worked for my specific area because my local utility had that renewable energy growth tariff program in place that they bought the electricity for twice the price that I would buy it from. I have heard that some other states offer a similar program. For example, I believe there's one in Minnesota, and I think there's one in Hawaii too. But what incentives are available in your specific community, in your specific state, really will depend on a huge number of factors. The only thing that you can say to anybody listening in the United States is that the 30% federal tax credit does apply to basically everybody right now. And if you are interested in getting started, do a Google search for local solar installers. There's actually a great website called EnergySage.com, EnergySage.com, where you can just type in your local address and it will help aggregate local bids from contractors that are in your area. And the thing to do is just contact a couple of them and have them come to your house and give you bids and just read through them and see what kind of deal you can get.
I can almost bank with near certainty that by the end of 2019, I will be able to tell you what the quote was for Brad's house on solar panels.
Yeah, it's certainly worth looking into, right? If you can get a free estimate, why wouldn't you look into it?
Right. I chose to pay cash for my system up front because I did not want to lease. I did not want to borrow for it. And I had the cash sitting there to do that. If you do not have the cash on hand to do this, there are a number of financing options that you can use. So you can borrow the money, which I know is like blasphemy in our community. But if you're borrowing at 4% and you could earn, say, 8%, then you are actually creating value from doing so. You can also lease the options. So there's some companies out there that will let you lease the solar panels and basically put them on your roof for $0 up front. Now, doing that, you will not qualify for the federal tax credit, but you can legitimately reduce your electric bill by, say, 20 or 30% by putting panels on your house with $0 up front. So there are a number of options available to you, even if you don't have $20,000 sitting around.
But it literally comes down to just, are you willing to do the math? And Brian, you've kind of been a little bit of a vanguard for us in this regards, in that you've already done it for your situation. So somebody listening to this that was like, whoa, I wonder if this is something that's available to me. Go check out the article. It's been released on ChooseFI.com. Listen to this episode again, and then hopefully that'll give you your action points. And if you find that this is something that you can use, we would love for you to let us, and I'm sure Brian would love for you to let him know. And let's just see, where this goes. So Brian, first of all, let's just pause and say part one, thank you so much for sharing that information with us. I know that, I'm inspired by it. And if you have some time, I'd love to talk about some maybe additional questions and feedback that we got from episode 75, unique advantages of the individual investor. Would you like to hang around for a little bit longer and talk about some of these questions?
Love chatting with you guys. Let's do it.
So I want to set the stage for the audience, people that maybe haven't taken my suggestion, which was to go listen to episode 75 first. And they're just hearing this and we want to get caught up. And basically the stage for this was that really up to probably closer to episode 70-ish on the podcast, we basically mentioned, in our view, the most simple, obvious path to investing. And that was using low-cost index funds, to which actually, frankly, Brian actually agrees with us in large part. And we were contrasting that with expensive, exorbitant assets under management, basically saying that you can and should and will do better in the long run just to, instead of trying to beat the index and leaning on someone else's expertise, net of fees, you will do better just following a very simple path to wealth. Brian made the case in episode 75 that there is an option C, and that the individual actually has advantages over the experts, over Wall Street, essentially, that just frankly aren't highlighted, and it would be a value add to our community to do so. And I think he made a masterful case for it. It was not saying that you had to do that or even should do that, but that people could do it. People with the inclination could do that. In our roundup, episode 75R, we highlighted pushback from our community, things that maybe they felt like we didn't mention in that particular episode, or that maybe Brian had glossed over. And it was all fantastic feedback, and it was worth talking about. And so now what we thought we can do, because we don't need to mic drop this and walk away. This can be an ongoing conversation. We're all getting better together. We thought we could highlight some of that feedback for Brian and give him a chance to tackle some of it, almost in a form of a hot seat. So Brian, you ready for this?
I'm ready.
We have some questions here that kind of got pulled from episode 75R. And one of the points that came up is that you are not a seasoned investor. So you've been mostly investing, according to the timeline in episode 75, you've been investing in a bull market where basically someone could just pick something that was at the front of the market, the biggest winners, and just follow those through. And of course you would look good. To be a seasoned investor, you need to have invested through bad markets, and a 5-year time horizon is simply too short to measure that. Any thoughts on that comment?
Sure. I've been picking stocks and investing on my own since about 2004. So I was investing throughout the Great Recession when the entire market declined by 50%. And at the time, the majority of my assets were actually in mutual funds that tanked right along with the market. So I have invested through that period. To that feedback, though, the last 5 years or the last 6 years is when my assets have all been at my current broker, and that's where I pulled all of my recent returns from. So that's where I was basically speaking from. But my current philosophy on investing in individual stocks really started to take off in about 2010. So I was not investing through the absolute bear market during that period. But to the point that if a bad market comes and my investments are going to fall drastically, I completely agree with that. But if a bear market comes, so will the Vanguard Total Stock Market Index. So if you were a holder of assets throughout the last bear market, you are a seasoned investor in that you saw your net worth decline drastically. And when I buy individual stocks, what's amazing is that over the last 10 years, the markets have gone up and up and up. But I have held many stocks that have gone from peak to trough down, say, 75%. Netflix, for example, is one of my biggest holdings. And when they came out with the whole Quickster debacle, that stock literally went from peak to trough down about 75%. And that was one of my biggest investments at the time. So I am much more of a seasoned investor with holding on to stocks that do fall drastically than I think people are giving me credit for.
Brian, if there is a crash or a major prolonged bear market, do you anticipate doing anything differently than, let's say, a long-term index fund investor would do? Or do you really believe in these companies for the long term? Like, talk me through how you would think about that.
I don't invest in a company, period, unless I believe in it for the long term. I never buy with the intention of holding for 1 year or even 3 years. I always buy with the intention of I want to be a owner of this business for the next 5+ years. Now, during that time, there could be something happen that just causes the entire story to change, and my thesis could change during that period. But if a bear market came along, and let's say the entire market fell by 20%, I would anticipate that many of the individual stocks that I held would fall by 30%, 40%, or even more. During that time period, I would maintain a shopping list, just like I do during good times, and I would buy stocks as they continued to fall that I continued to like for the long term at better and better prices. So my strategy of dollar costing average into the market every single month, just like you guys preach with the Vanguard Total Stock Market Index, is very similar.
Another thing, Brian, that really strikes me, and that, feedback that we got, that we kind of glossed over, the amount of time necessary to learn this skill. It's great for you if you love this, if you dig this stuff, but it's a lot of work. I mean, it just seems like this really has to be something that you get excited about. And if you're not willing to put in hundreds of hours of research, then this is going to be out of reach for you. And that's some feedback that we got. I'd love your thoughts on that.
I 100% agree. Buying individual stocks does take much more work, especially upfront, than it does to just index, which is the very reason that I think index funds are the right choice for, let's say, 95% of the people that are listening to this. If you do not have the time or the inclination to do the research and learn about investing along the way, the default option for everybody should be indexing. I'm not here to advocate that everybody should pick individual stocks by a long shot. I just think that for the people that do have the time, that are interested and are willing to put in the investment to do it, to learn how to do it, it is possible to beat the market over time. It is possible to have a return on the time that you invest. I know that I have seen that personally. And again, I'm a huge proponent of index funds. It's just the recurring theme that I heard throughout the FI community is that people that buy their individual stocks are morons. They're wasting their time. I just think that is a fundamentally flawed argument.
Brian, how much time do you estimate you spend now per month? So let's say I know you have these detailed spreadsheets, you have these watch lists. Talk us through how much time you spend now, but also probably more importantly, when you were studying this and when you were setting up these watch lists. Because at some point, while you have all these intricate Excel sheets, at some point they were blank. Did you go through a bunch of companies all at once, or did you just do it one a week? Talk me through how you actually created that watch list.
Sure. Well, the first step to any process is educating yourself. So the very first thing I did was read as much as possible. I went on free websites like Fool.com, Seeking Alpha. I read absolutely everything that Warren Buffett has ever wrote. So there was a substantial investment on my part up front, learning about how to interpret financial statements, what makes for a good business, what are the key principles of building a portfolio. So it did take me hundreds of hours up front to kind of learn and build. Then from there, I kind of layered in individual stock investing on top of my strategy, which at the time, unfortunately, was based on mutual funds, which we both, I think, can agree are not the way to invest your money. So I don't think there's any rush. I don't think there's any need to do, if you are not interested in doing the work up front, sticking with index funds is the way to go. If you only have a little bit of time to put in, I think a wonderful strategy is to devote 90 or 95% of your assets to index funds and slowly layer in individual stocks over time as you grow comfortable with the process and as you can devote time to building out your watch list. But to answer your question, how much maintenance is there in any given, like, say, month or quarter? That depends on how many stocks you own and what your time frame is and what's going on with the company. Personally, a company that I own is MasterCard, which I just think is one of the best businesses on earth. That's a company that I devote very little time to because when their earnings report comes out, the company is so consistent that I can just read it top to bottom in a couple of minutes and just say, yep, the story's on track. Conversely, I own a company that is very high risk, very intense, takes a lot of focus, called Tesla. And that is a company that I spend a lot more time on reading their earnings report because there is so much more that can go wrong. But if you just had a portfolio of, say, 10 stocks in addition to your index funds, you could devote maybe, say, an hour of them, an hour once you understand the process and get set up, an hour per quarter, maybe a little less, maybe a little more. Depends on you.
What about feedback that individual investing is gambling and you can never know what's really going on inside of a public company? I mean, we mentioned, kind of this fiasco of Enron in our feedback episode. The index can never go to zero, or if it does, you have bigger problems. But an individual company, it can. What are your thoughts on that?
Sure. Enron is obviously an example that everyone likes to point to, and for good reason. That company was an absolute train wreck. But there are some stocks that literally cannot go to zero. One that we've discussed, Jonathan, is Facebook, for example. Facebook has, I'm going to make up the number, but it's in the ballpark of being wrecked, about $60 billion in cash on its balance sheet and zero debt. So while Facebook's stock price will vary widely over time, the company does not have any debt at all in its business, and it has $60 billion in cash. That cash is worth something. So if Facebook stock traded for, let's say, $1 per share, somebody could come in, buy the entire company for that $1 per share, and then have access and then take ownership of that $60 billion in cash. So Facebook is an example of a stock that literally cannot trade for zero. So on the feedback of individual investing is gambling, I disagree. Individual investing in good companies that you know of, that you've heard of, that you use their products and services, that have good economics going on, that is buying something and then betting on that company to continue prospering. Will you ever be able to know what's going on inside the company? Absolutely. I mean, there's no way to do that unless you work there and are in the C-suite. Take a company like Amazon, for example. Everybody listening to this has probably heard of and been a customer of Amazon for at least 10 years. I know I myself have been a Prime member for going on about 8 years now. I didn't start investing in Amazon personally until 2010, which is when hundreds of millions of people had already been customers and heard of that. That seems like I got in way too late. That seems like the story was already played out. My position in Amazon is up several fold from when I bought in 2010. Am I ever going to be 100% positive that Amazon doesn't have anything shady going on? There's no way to know that for sure. That is why we are huge fans of a diversification. That's why you never concentrate all your assets into a single company. That's why it's important to spread your bets across a dozen or more stocks. That's the exact same principle that drives the Vanguard total stock market. The Vanguard total stock market doesn't have all of its assets in one company. It has it spread across thousands of companies. And that's how you protect yourself from something going wrong with any given company.
Brian, the final question I wanted to run by you is exit strategy. So you're holding this stock and it's going down by 70%. When is it just your gut and you're just gambling, right? Oh, I think it'll come back up. I think this will be a good thing. How do you flesh out a solid exit strategy, one that's based on principles and not just emotion?
As I said previously, when I buy a stock, when I buy an individual company, my initial goal is to hold it, quote unquote, forever. Warren Buffett has a famous saying that says, when we own outstanding companies with outstanding managements, our favorite holding period is forever. So the idea is that when you buy a good company, that company will compound itself over time. That will take your initial investment and grow it and grow it and grow it continually. So the best time to sell or the best exit strategy is no exit strategy, where you hold the company and it just continues to grow. And eventually down the road, when you need that money for whatever purpose you invested in the first place, to pay for college or to, just retire on it and live off of, that's when you would be looking to sell it. But my personal exit strategy is always based on, is the company performing as I expected it to perform? If I bought, say, I'm an investor in Amazon, as I mentioned, the investment thesis is Amazon is going to continue taking market share in the retail world. More people are going to come to them. They're going to sell more stuff each and every year, and they're going to remain the top player. If, for example, down the road, it looked like Walmart, which is I believe the number 2 player, all of a sudden had a huge online presence and really started to dig in, and Amazon was no longer growing, that's when the story changes. And that's when you think about trimming your position and plowing it into another investment. Or if the company becomes so successful that it is an enormous part of your portfolio and you're looking to reduce your risk, you can start to sell off your really big winners and look for other companies to invest in. So there is no defined exit strategy other than I'm going to buy this company and hold it as long as it remains great.
So Brian, I caught a important distinction in there. You said, is the company performing? So that's not, is the stock price performing, right? You're looking at a company that you intend to hold this position forever, right? So you're talking, is the actual company performing as well as I anticipated in my investing thesis, not the stock price, correct?
That is 100% accurate. When I judge how a company is doing, I'm always looking at its financial statements. I'm always looking at its revenue, its profits, what kind of things it's investing in, what are its growth properties, that kind of thing. The stock price is something I also look at, but when I judge a business's success, the short-term direction of the stock price is almost never a factor. It is always, how is the business, the underlying financials of the company performing over time? It is not which direction has the stock moved since I purchased it.
So follow-up question on that, just to maybe apply that to a company. So let's say that Apple just hypothetically releases a brand new $1,000 phone. All right, maybe it's not so much of a hypothetical, but basically you have this company that releases this great product or this very, very expensive product, and the market is a little bit weak for it. And everybody's screaming, oh, wow, has the market gotten too saturated? Something else. Like, how do we take this kind of concept and apply that to a specific company that's top of mind?
It depends on your expectations of that company up front. If your investing thesis in Apple was they're going to come out with a brand new phone and it's going to drive continued revenue growth, and they fail to deliver on that, that's when you need to reevaluate your thesis. However, if you are an investor in Apple and you think, I think the ecosystem is what's valuable, I think the iMac sales and the sales of the iPhones, not just one particular one, but all of them, or sales of the services business, if those things continue to grow, even if they have one weak product, that's what you need to look at. You don't look at one specific product, you look at the entire business as a whole. Now, Apple is a unique company because they're worth 800 billion or 900 billion, and they're enormous and they're so well covered. They have so many different kind of products that are going on that you can't really say this is a failure or this is success based on one single product sale. You can do that with smaller companies. When a company is, say, under $1 billion, they usually sometimes have one product, one service that is growing in the marketplace. So it's a lot easier to look at.
Brian, thank you so much for coming on the show today and sharing both your solar panel cost analysis, but also being willing to tackle some of these questions, man. It is really a treat to have you back on the show.
Always a pleasure to talk to you guys. I absolutely love your podcast and I listen every week. Keep it up.
Brad, it's always so much fun to get Brian on to have him share his perspective.
Yeah, there's no doubt about it. And it really opens my own horizons, and I hope it does for people out there. A lot of us lock into the index fund investing, and for good reason, obviously, but I just love the mental reframe that Brian takes on the stock market investing and individual stock investing specifically. For him, this is not gambling. For him, this is being an owner of a company that he intends to own for many decades. So that came through extremely clearly for me. He considers himself an owner of this company, even if he only owns 50 shares. That is the way that you need to approach this. And that's the way that he does. And he believes this is a successful plan for his investing life for the next 50 years of his life. So I'm really always just so impressed when Brian comes on.
And frankly, Brad, it's something that me and you can't speak to because we've chosen our path. We've chosen a very simple path, and it's something that we're very comfortable with. But it doesn't need our audience doesn't need to be limited to just what me and you have done. We have a wonderful community with diverse opinions of things that they've figured out. And just like this solar panel cost analysis, there are so many people that are going to go get a quote just frankly based on this little segment. And some of them are going to discover that they are going to get this similar results to what Brian was able to get. And so to our audience, if you listen to this and were intrigued, there will be an article linked in the show notes where his entire cost analysis is broken down for you. And you can riff through that and figure out a way to start doing it on your own. He has some of the links that you'll need in order to find out whether or not there are credits in your area. And just how cool would it be for you to find out that you could pull this off as well? I wanted to reiterate that in many cases, some of these things are time sensitive. There are credits available at the federal level, very, very lucrative incentives. I think he was mentioning essentially a 30% tax credit, and those are going to be starting to phase out into 2019 and beyond. So this is something that if you do the cost analysis and if it makes sense, you don't have to do this. Obviously, this is not a dogmatic thing, but if it's something that you want to do, there are financial incentives for you to pursue that in the immediate future. And it'd be pretty cool if you were prompted to look into it based on this show. We'd love your feedback. All right, guys. Well, unfortunately, that is going to bring this episode to a close. Now, as you know, we like to finish every episode by doing a drawing for a copy of a book that we have found useful. And there's 3 books that we offer. The first is J.L. Collins' book, The Simple Path to Wealth. The second is Dominic Cortuccio's book, Design Your Future. And the third book from Vincent Puglisi, Freelance to Freedom. If you want to enter the drawing, all you need to do is just go to ChooseFI.com/iTunes, follow the instructions there, and leave us a short written review on either iTunes or Stitcher. And then send us an email to feedback@ChooseFI.com, letting us know that you left a review and what screen name you left it under. We give away 1 book for every 5 written reviews that we get, and we announce a winner on the Friday Roundup. Brad, how many winners do we have today?
All right, Jonathan, we have 1 winner today, and the winner is Rachel. And Rachel called the podcast life-changing. I discovered ChooseFI about 6 months ago, and my life hasn't been the same since then. I had just returned from a deployment and was looking for ways to optimize my financial situation. A friend recommended I listen, and I've been hooked since then. As a newbie in the personal finance FI space, I've received so many actionable tips from every episode, and have not only optimized my finances, but my life as well. I'm about 2 weeks away from paying off all of my student loans, and I'm looking forward to implementing more of the investment and saving tips I've learned from ChooseFI after I accomplish that milestone. Thank you so much, Brad and Jonathan, for everything that you do.
That is so exciting. We are so excited for you and to see where this goes into the future. All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.
You've been listening to ChooseFI Radio Podcast, where we help middle-class America build wealth, one life hack at a time.